This is a special edition of our video series based on the recent tariff announcements by President Trump and his administration, and we're going to talk about how that might have impacts on the market. So on April 2nd, President Trump announced new tariffs on nearly all major trading partners. These tariffs are reciprocal in that they correspond to tariffs each country imposes on U.S. goods and are on top of previously announced duties. Now, I understand the math is a little difficult to understand, and in fact, the formula that the Trump administration used is very complex and has been broken down and argued about for and against by people who are for the tariffs and people who are against the tariffs. So putting that math aside, the average tariff rate across countries is 25%, according to the Trump administration, with rates for some as high as 49%. Now, the implementation of these tariffs was widely telegraphed by the White House. The level and scope, though, are greater than many investors and economists expected. So the immediate market reaction was negative, with the S&P 500 declining over 3% and the 10-year Treasury yield declining to around 4%. Now, there are many arguments for and against tariffs, and the topic can be politically charged. Regardless of how we each feel about these measures, one thing we can all acknowledge is that these tariffs do represent a significant change in the global economic system. It's important in times like these to remember that markets can be fragile in the short run, but are resilient in the long run. Over the past century, markets have experienced significant global economic shifts, including wars, recessions, bubbles, pandemics, political change, technological revolutions, lions, tigers, bears, oh my. So in times of uncertainty, it can feel as if markets will never stabilize. Yet history shows that markets can overcome even the most significant shocks and often rebound when it's least expected, as they did in early 2009 after the global financial crisis, in mid-2020 during the pandemic, in late 2022 after a technology-led bear market, and across countless other examples. So having the fortitude and the discipline to stay invested and stick to a personalized financial plan, or even to take advantage of more attractive valuations, is a key principle to long-term financial success. Let's cover some of the key facts. The newly announced tariff measures have been set at a minimum 10% rate, with levels varying based on the U.S. trade deficit with each country. This chart shows reciprocal tariff rates announced by the White House on April 2nd. It also shows the level of tariffs on U.S. goods by other countries, provided by the White House. These reciprocal tariffs are on top of previously announced tariffs. China, for instance, faces a reciprocal tariff of 34%, and that's in addition to 20% tariffs previously announced. The European Union will be subject to 20% tariffs, while Canada and Mexico are not immediately impacted by new reciprocal tariffs. Instead, they are subject to the previously announced 25% tariffs that are related to illegal immigration and fentanyl. There's also an across-the-board 25% tariff on all imported automobiles effective immediately. The United States has a long history of tariffs, and in fact, they were the primary source of federal revenue prior to the establishment of the federal income tax system in 1913. However, they fell out of favor after World War II as globalization took hold. The Trump administration's arguments for tariffs are to raise revenues and ensure economic fairness, especially in the manufacturing sector, a policy it has dubbed Make America Wealthy Again. President Trump's long-stated goal of reducing the trade deficit and the view that trade is unfairly balanced were on display in his April 2nd speech. Arguments against tariffs are that they effectively tax consumers, who ultimately pay higher prices for goods. This is particularly sensitive today due to the inflation that households have experienced over the past few years. Historically, it's argued that periods of high tariffs may have worsened the Great Depression and slowed global economic growth. Now, President Trump and his administration argue the opposite and say that what actually caused that global economic meltdown back during the Great Depression was due to the movement in the U.S. from tariffs to income tax system, which did happen about that same time period. So there's the argument back and forth. This chart shows the Economic Policy Uncertainty Index, or the EPU index, which quantifies the level of uncertainty related to economic policy decisions. In this chart, you can see how high EPUs have sometimes been associated with recessions, as indicated by the gray bars on the graph, or the shaded area on the graph. It'll take time to truly understand the impact, although some areas will be affected more than others. The general fear is that tariffs could shock the economy, potentially spurring inflation and slowing economic activity. As such, markets have already reacted negatively this year. For example, while some domestic manufacturers might benefit from less foreign competition, markets tend to view trade barriers as negative for corporate profits, at least in the near term. Just as in the past, new trade policies force businesses to reconsider how they operate. They may adjust their sourcing strategies and can consider absorbing portions of the tariffs themselves. In response to the 2018 tariffs, a portion of S&P 500 companies shifted their supply chains out of countries like China to reduce the impact from tariffs. These corporations relocated manufacturing facilities, they found alternative suppliers, or adjusted their global production networks. While this can help companies navigate this latest round of tariffs, it takes time to adjust supply chains. The S&P 500 sectors that are most directly impacted could be the ones with the greatest proportion of revenues coming from international sources. Nearly 30% of S&P 500 sales come from overseas, with information technology, materials, communication services, consumer staples, and energy having the largest exposures according to Standard & Poor's. In addition to the impact on revenues, tariffs will likely affect company profit margins by raising costs for foreign-sourced components. Prior to the April 2nd announcement, the estimate for 2025 S&P 500 earnings growth had actually fallen to 11.5% from 14.2% at the start of the year, according to FactSet. However, it's important to note that this is occurring at a time when operating margins are historically high and productivity growth is rising. This could provide some cushion for profits. One important fact is that a weaker dollar can be positive for both investors and companies as well. When it comes to asset allocation, international stocks have performed better this year, and a weaker dollar means that international assets are potentially more valuable in U.S. dollar terms. For companies, a weaker dollar can spur foreign sales since the cost of U.S. goods sold abroad becomes cheaper for foreign buyers. Despite the immediate market reaction, it'll take time for the true impact of these trade policy changes to play out. In recent years, investors have faced numerous market concerns, including the pandemic, inflation, the possibility of a Fed policy error, recession fears, and more. Each of these challenges likely felt insurmountable at the time to some, yet markets not only recovered, but they rose to new levels over the following years and decades. While the past is no guarantee of the future, there are many reasons to believe markets and the economy can eventually move past the current set of concerns. Perhaps Warren Buffett said it best in 2008, during the middle of the global financial crisis, and I quote, "In the 20th century, the United States endured 2 world wars and other traumatic and expensive military conflicts. The Depression, a dozen or so recessions and financial panics, oil shocks, a flu epidemic, and the resignation of a disgraced president. Yet the Dow rose from 66 to 11,497. This is a helpful reminder that although market swoons can be unsettling, history shows that keeping a long-term perspective is the best way to stay on track to achieve your financial goals. If you'd like to know more about how the new tariff policies might affect your goals and portfolios, reach out to me to schedule a consultation. We can take a look at what you're currently doing and create a personalized financial or investment plan just for you. As a CFP professional and financial advisor with Milligan Wealth Management, I help my clients examine portfolio risks and returns so that their portfolios are aligned with financial goals and tolerance for risk. Find out more about how you can align your investment risk and returns with your financial or retirement goals by visiting my website at milliganwealth.com, where you can check out blogs, tools, calculators, articles, and other helpful videos. Thanks for watching. If you found this video helpful, don't forget to like and share it with others, as well as subscribe to my Milligan Wealth YouTube channel for more insightful personal financial content. Until next time, I'm Bud Milligan, your financial bud.